Manishi, how do you view this, both structurally as well as from an India standpoint, optically as well as from an India investor standpoint? How are you seeing it?
Right. Thank you very much. Thank you very much for having me, and a very good morning to you and your viewers. I think, it's undoubtedly good news, especially coming on the heels of the India EU FTA that was signed a little more than a week ago. It does two things. Number one, it assuages a lot of concerns about, I think, the rupee. We are seeing that in the rupee appreciating, I think around somewhere between 1 to 1.5%. We had seen of late, particularly in the October data, that the monthly trade deficit had expanded to about 42 billion. So there is a significant possibility that the trade deficit would decline, it would moderate again, which should, sort of assuage concerns on the balance of payment situation and therefore stabilize the rupee. I would think that this should also lead to some kind of a revival in the FII flows, because there had been the FII selling that we had seen was basically predicated on two things. Number one, this decline in earnings estimates and the decline in margins that we have seen for the Indian corporate universe as a whole over the last couple of years. And of course, the concern on the currency. So I think if these two things get addressed, if there is a degree of employment creation, employment generation in the export intensive sectors, then we would have, clearly we would have a better picture. I think it may be too early to say that the last 15 to 16 months underperformance of India has come to an end, and this is the inflection point. For that, I would still wait for the earnings estimates to revive, but it's definitely a good start.
Yes, it is. But I think the question, Manishi, now is, as an investor, what do you do? Most people would have actually sold into Sunday's weakness and perhaps a little bit further yesterday too, other than few odd short covering led trading positions perhaps. Do you now take a fresh look at the sectors that you had been completely avoiding? That's the export-linked sectors.
Right. As far as merchandise exports are concerned, particularly harmful to the Indian export-linked sectors, the harm from the US 50% tariff was in textiles, in leather goods, in small engineering and auto components, in some of the aquaculture and aquatic products, jewelry. So those, 5 or 6 sectors, they had suffered the most. I would think that, and those sectors, many of them are actually governed, they're hugely populated by the mid caps. So I think some degree of interest would come back into them. Particularly, I would look for the companies that have a significant degree of exposure to the United States. There are quite a few textile exporters which are in that bucket. So yes, I think, broadly, the laser focus of investors initially would be on those sectors. But at the same time, we must also understand that this has macro implications. This has implications for the rupee. This has implications for longer term employment creation. This has implications for, consumption sentiment as a whole. And therefore, this has implications for longer term earnings estimate increases. So, just focusing on the merchandise export oriented sectors may be a bit too narrow.
What is your view on the fact that we have now seen the rupee appreciating nearly 1% in today's trade? Do you think that that would be one of the triggers for foreigners to look at the Indian markets? Now they've been staying away because of the valuation, and we are now inching up to about 26,000 again, and they've been selling all the while for last 12 months.
Macroeconomically, there are broadly three factors that influence the equity market. They are earnings, they are currency, especially in the emerging market context, and their interest rates. Now, if you look at the last maybe 1.5 years, two of these factors were going against India, and only one factor, which is interest rates, was possibly in favor. Because of the very low inflation, there was a lot of room for the Reserve Bank of India to cut rates, and I think that room still exists for at least two, maybe three more rate cuts. Now, what has happened with this trade deal, and it's not the one in isolation, but we also have to, consider the India-Europe trade deal. It has, it's possibly, kind of, I wouldn't say putting a floor on the rupee, but at least it's addressing the big concern on the balance of payments, which India was suffering from. So it is the second factor, which is the currency, which is now beginning to fall in place. And I would think that there is a degree of interest which FIIs would obviously be, the FII interest would obviously be reviving as a consequence of this. The third building block also needs to fall in place, which is earnings estimates. And that's something we're still waiting for. Despite the, the massive consumption stimulus that was injected in 2025, we're yet to see that impact on the earnings estimates in consumer discretionaries or in the other sectors. So yes, I think it's kind of addressing 2 out of 3 factors. We need that third factor also for this interest to become a bit more sustainable.
Manishi, it was a pleasure talking to you today. Thank you very much for joining in what we are seeing is going to be a big day for the Indian markets. And we're now joining